The activity of the option dealers or market makers in the options markets is probably one of the most complex concepts in the world of trading. Gamma levels are on everyone's lips these days, but in fact, hardly anyone really understands what is behind these price ranges and why these levels can be so valuable for us. We have dedicated an entire online course on this topic. Up to now, you can only purchase this course in German language, but we're currently working on an English version too. It'll be available by the end of 2025. You can purchase it on TradeNeon.com. With level of interest, we take the complex and time-consuming work of Gamma and Vanna analysis out of your hands and provide you with the truly relevant dealer hedging levels synchronized in your chart and with corresponding notes on which levels we are most likely to expect a certain movement in one or the other direction. Let's briefly discuss the idea behind these prices. Although the options markets are gigantic in volume, since the volume and open interest are spread across hundreds of strike prices and expiration dates, individual options can be very illiquid. Nevertheless, to ensure smooth and efficient trading, the options exchanges pay so-called option dealers comparable to classic market makers. Their job is to ensure liquidity. So they will take the opposite side of your desired trade if no suitable counterparty can be found. In 80 to 90% of cases, the counterparty for your options trade will always be an option dealer. As already mentioned, the exchange pays them for this with your fees. However, the option dealer's actual business model is high-frequency trading. The market maker will immediately try to get rid of the trade he just entered into with you on the other side of the order book in order to make a quick profit on the spread. In most cases, he succeeds, but in many cases, he does not. Then the dealer sits on an open trade with a directional risk just like you. However, this is not in line with his business concept and is not in his interest, which is why he will hedge himself immediately, thus neutralizing his trade. He does this by buying or selling the underlying on which the option is based in a certain ratio. As you can see, the option dealer directly intervenes in the underlying market by buying or selling it, which of course also influences its price development. This influence should not be underestimated and now accounts for 1/3 of the total trading activity in the S&P 500, for example. These are unimaginable sums. As private traders, we are therefore well advised to take a look at the trading activity of option dealers and to take advantage of it. The advantage here is that we know exactly where the dealers have to take action to adjust their hedges. They are virtually forced to do so, which gives us a huge advantage. The amount and type of their hedges is measured on the basis of the so-called delta of an option, which we call one of the Greeks. We don't want to go too deep into option theory here, but the fact that delta is dynamic and constantly changing is important. The main factors responsible for this are the price development of the underlying, the time value of the option, and the implied volatility of the option. These three factors are represented in the world of options in relation to the delta by the three secondary Greeks, Gamma, Vanna, and Charm. These three factors therefore constantly influence and change the delta, which in turn means that the market maker has to adjust his hedges to the new delta at certain prices by buying or selling the underlying again. We know exactly where these levels are and what the option dealers have to do there. This is an enormous advantage that many private retail traders are unaware of and do not know how to use. However, you have to bear in mind that other major market participants also have knowledge about these levels and use them for their own agenda. For example, if we have a price range in which the dealers have to buy in order to adjust their hedges, we generally assume that the price will rise from here. However, this is not always the case because institutional traders are, of course, very happy to use this liquidity to build up their own short positions, for example. So there can be strong breakout movements in the opposite direction. As a general rule, remember this. We always plug the Vanna levels, as Vanna typically has the most significant influence on the price action throughout the day. Green levels represent bullish dealer hedging levels. Under normal conditions, option dealers are more likely to buy the market at these levels to adjust their hedges. Red levels, on the other hand, should be interpreted as bearish. However, let me repeat. Other market participants are also aware of the liquidity provided by the market makers at these levels. Therefore, it can never be assumed across the board that the market will always react bullishly to green levels and bearishly to red levels. While Gamma is typically hedged precisely at specific strike prices, the effect of Vanna and Charm is more holistic. Even strike prices that are far out of the money can have an impact on the market. When multiple nearby strike prices exert the same directional influence, either bullish or bearish, we can use this to draw Vanna zones on the chart. Large green price areas are referred to as bull zones, while red areas are referred to as bear zones. These zones can be used to form our bias. They are one of the puzzle pieces we evaluate to determine whether we should lean toward a long or short positioning. We can also use these zones as effective filters. For instance, it makes sense to focus more on long entries within bull zones and to look for short trades within bear zones. One final important note. Most software that provides Gamma and Vanna levels work on the basis of the false assumption that all puts are always bought and all calls are always sold by retail traders. This is absolutely false in the modern market environment, and we therefore only include high-quality data that calculates the actual exposure at each individual price. Furthermore, most conventional software converts the prices of SPY to the ES future or from SPX to the ES future based on a simple mathematical formula. This approach has not proven effective for us in practice and has even proven to be fundamentally flawed simply because the relative relationship between these markets is also very dynamic and constantly changing. So again, we make extensive use of the order book to determine the exact prices at which the dealer's hedging levels for the associated ETFs or indices are actually in the future, so that we can provide you with these levels with maximum accuracy.